Here we go with some multiple choice questions on our cost methods of cost accounting. Which of the following costing methods provides the added benefit of usefulness for external reporting purposes? We have variable and absorption costing. All right, with these two methods of costing, I really want to bring your attention to the more memorization based. We have a wonderful chart here, which I'm going to bring to your attention. Here it is. And these two methods, the real big difference between them are the treatment of fixed costs. Now, again, these are costing for your inventory. Do you treat fixed costs as periodic or product costs? The big difference, and what does all this mean? And this is something to memorize, this chart. I would for sure memorize this. Fixed costs, when you're manufacturing under the variable or direct method, you expense those fixed costs. You put them on the income statement and they are treated as expenses. So as such, it reduces your net income. With your absorption costing, you take the fixed costs, again, those are like utilities in the factory and keeping the lights on, maybe salaries for your administrative people. You are going to add those to the product and make those inventoriable costs. So if you make $10,000 of product in the month of May, right here we go. I made $10,000 of product in the month of May, and let's say fixed costs are $2,000. Under variable costing, and it's kind of like this is like a big nothing burger. It's kind of wild. This whole thing, it really just comes down to this one chart. It's just two methods in treating fixed costs. Under variable costing, so this is the cost of materials and labor. This is your inventory value. Under this method, fixed costs, these going on the income statement as an expense. Net income is going to go down by $2,000 because of this. Obviously, it's an expense. And as such, variable costing has the lesser net income. Absorption costing, you are going to capitalize these fixed costs. That's just the treatment. That's just how it is. Inventory value is now $12,000. You do not reduce net income. This goes in the balance sheet. The cost is a balance sheet amount, and it's treated as such. It'll go into cost of goods sold when it is sold. So you see here the differences. This is a capitalizable amount, which generally speaking, capitalizable amounts are preferable because it bolsters your balance sheet as an asset rather than adding an expense on your income statement and reducing your net income. But why do we have these two methods? And what's the difference essentially? Well, absorption costing is used for external reporting. This is used for GAAP, FASB, reporting your financials, whereas we use variable costing for internal decisions. And why would we do that? Because fixed costs don't really go into, if you think about it, keeping the lights on, maybe you could justify the fact that those costs will go into your inventory. But if you're trying to determine what inventory is profitable or not, you're going to remove it and just use the direct materials and direct labor of $10,000. And this is just how they want you to report it externally. Now, two ways to approach these sorts of questions. Just memorize the chart. You can try to understand it for sure. And I'm not knocking you. I'm not trying to say don't try to understand it. But I would for sure understand it, memorize it a little bit, memorize this chart. Fixed costs are periodic costs, which are on the income statement. Under absorption, they're product or inventoriable, which means they're capitalized, added to inventory on the balance sheet. Fixed cost impact to net income. It's a reduction under variable costs, and again, no effect under absorption. Used for internal decisions, the inventory value is the lowest under variable. It's the highest under absorption. What are product or inventoriable costs for variable? It's all cost of goods manufactured except overhead. That's materials and labor. Absorption has all cost of goods manufactured, which we know is materials, labor, and overhead. All right, so in this case, my answer is going to be letter B. Awesome. Great first question, off to a good start. Next up, variable costs would consist of what? Well, we have fixed selling costs, we have general and admin, fixed overhead, and direct material costs. All right, so what costs are variable costs? The costs that go up when you make more and go down when you make less. Well, fixed selling costs, these are not going to be variable. I mean, it's in the name, it's fixed. Right? That's not going to be the case. This could be paying your salespeople a fixed salary. General and admin expenses, these will generally be fixed. You're paying to keep the lights on and paying to keep your accountants paid. Fixed overhead, same sort of thing. Utilities, keeping the lights on. I love that phrase. It just really describes your fixed costs. Now, if you have a cost that goes up, like for example, maybe you're using a same amount of electricity, the more you make, then that's a variable utility cost. But generally, like just keeping the lights on, that's a fixed cost. And direct materials. Direct materials, this is for sure variable cost. It's the most direct variable cost ever because the more you make, the more inventory you make, the more direct material costs you will have. Because that's the most direct thing that goes into it. I mean, labor, for sure. Labor is also a variable cost because you'll only pay people to make these things as you make more. But materials is for sure the most direct. Awesome. Under the absorption costing process, production costs would include all of the following except which? Back to our good old absorption versus variable or direct. Well, we know what is the big kicker here. It's all about fixed costs. That's the big thing. So absorption, we remember, is the one where they're all capitalized, right? We're all capitalizing everything. Product cost would include all of the following except which. So the only product cost not included here is variable manufacturing overhead. Variable and fixed selling and general admin are period costs. Under absorption, this is going to be included. This is going to be included. Cost of goods manufactured, remember, is materials, labor, and overhead. And labor will be included. Selling, general, and admin, it's not about the variable here. It's about the selling, general, and admin. These are not product costs. Product costs are inventoriable costs, which go into the cost of the inventory, which go on the balance sheet as your value of inventory. However, these are always going to be period costs and put on the income statement. That's the kicker here. Again, just to reiterate our formula, cost of goods manufactured or product costs, generally speaking, and what I mean by generally speaking, I mean under the absorption method, it's direct material. You've probably seen this a million times. Direct material, direct labor, plus overhead. Now the difference here is when we're doing the direct or variable method, same thing, just different names. Boom, get rid of that. This is what we have. But here, those are our product costs. These are not. These go on the income statement. Last up here, I'm going to read the question for, it's not too bad. A company has 2 departments and allocates all overhead costs based on department revenues. The following information applies. Department 1 revenue is $1 million. Department 2 revenue is $1.5 million. Corporate overhead costs $250,000. Department overhead costs of $175,000. What amount is the company's total overhead cost for Department 2? Okay. Now, this is joint costing. If you've seen this, let's run through it. Joint costing essentially is used when we have costs that could be applied to 2 different product lines, or in this case, departments. And we need to allocate, for example, like corporate overhead or department overhead to those proportionally. Because, like, what's fair? Like, what makes sense? Well, we need the weightings of these. Like, first off, what are we allocating? We need to allocate, like I said, the corporate overhead of $250, because let's say you're making, Department 1's making shoes, Department 2's making shirts. You have these general fixed costs. Maybe they're fixed, maybe they're not, but these are just general. Think of them in the corporate office. But under joint costing, you need to allocate these costs to your departments. Okay, so we need to allocate that $250 plus $175. Obviously, the $1 million and the $1.5 are direct to Department 1 and Department 2, respectively. Okay, so $175 there. So total overhead that needs to be allocated is $425. And likely this million and this $1.5 million is materials and labor, Now this is the process of allocating that overhead. This, if you're familiar, if you remember from WAC, which you definitely should know in this exam, weighted average cost of capital, the weighted average calculation is very similar to that. Well, what makes sense to allocate them among this? Well, okay, Department 1 obviously has less weight than Department 2 because Department 2 has more revenue. The total amount here is $2.5 million. Department 1 revenue of $1 million plus $1.5 million is $2.5 million. As such, Department 1, we're going to do 1 million divided by 2.5 million. Department 2, to find its weighting of what gets allocated here, it's 1.5 million divided by 2.5 million. See what we did there? Same process as our weighted average cost of capital in our finance section and capital structure, and that gets us to 40%. That gets us to 60%. Wonderful. What do we do here? Well, we're only concerned with Department 2. As such, Department 2 is getting 60% of the joint costs. It's allocating 60% of the joint costs to Department 2. Finishing this out here, we're saying 425 times 60% equals $255,000. Final answer is going to be letter C, $255,000. Awesome. Now, a question could ask, what is Department 1 as well as Department 2? What is Department 1? Doesn't matter. You'll be able to handle it based on this. You'll take it down. It might say we use joint costing. It might not say joint costing, but this is the general format for a question such as this. It talks about overhead costs, talks about two different segments. It could be, mirrors versus tables. It could be Department 1 versus Department 2. It could be one state's manufacturing plant versus the manufacturing plant in another state. Doesn't matter. You will be able to handle it. Wonderful, wonderful there. Thank you all for joining. Stay strong. You're doing well in this exam. It's just one question after another. If you're doing 100 questions today, bump it up to 120. If you're doing one sim, try to get 2 in there. I have faith in you. Sacrifice this exam, but you will get through it. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.